All right, buckle up, because we're about to crack open the vault on a stock that surged over 400% in just a year. Seriously.
It's quite the story.
You won't believe these numbers, and the truth behind its valuation, they might just shock you. This is insane. Stick around. Today we're doing a full deep dive into Palantir Technologies, ticker PLTR, and asking, what's the real story with its valuation?
Yeah, we're going to explore what Palantir actually is, why it's, all over the headlines, and what these frankly eye-popping numbers could mean for its future.
Okay, but before we jump right in, just a quick but really critical note. You're with ChannelVest as this is your analysis. Remember, this deep dive is purely for informational purposes. It is absolutely not personalized investment advice. You should always, always consult a licensed financial advisor before making any investment decisions.
Right. And while we've used AI, web research, expert analysis, and believe the data is accurate now, things change fast. We don't assume liability for errors or losses.
And the big one, past performance never guarantees future results. Okay, disclaimer done. Let's unpack Palantir. So let's start at the beginning. For anyone maybe less familiar, what exactly is Palantir? What do they do?
Well, at its core, Palantir Technologies is an AI-powered beta platform. Think integration and analytics. They help big organizations, governments, large corporations make sense of incredibly complex, often messy data.
So they connect the dots between all sorts of different information sources.
Precisely. You got it. It could be helping governments track threats or helping businesses streamline their operations, making data useful, essentially.
And how did they get here? Weren't they mostly government-focused initially?
Yeah, they started back in 2003, primarily as a government contractor, very focused there, but they've really evolved. Now it's a dual-segment business, serving both public and private sectors. Their main platforms are Gotham for government and Foundry for commercial clients.
And now there's AIP,
Yeah.
right? The artificial intelligence platform. That sounds huge, especially now.
Oh, absolutely. That's their newest offering, AIP. It basically integrates large language models, the kind everyone's talking about, with the company's own data. It enables AI-driven decisions right within the enterprise. It's potentially a massive game changer.
Okay, makes sense. A game changer. So diving deeper into how they operate, how does that revenue split look between government and commercial now?
Right now, the government segment is still the larger piece, about 55% of revenue. That's mostly the Gotham platform for defense, intelligence, federal agencies. The commercial side makes up the other 45%. That's a Foundry platform, corporate data analytics, AI applications, that sort of thing.
So still majority government, but commercial is significant.
Exactly. And this dual focus, it positions them pretty uniquely to capture market share in both areas.
But, with interest rates normalizing or trying to, high valuation growth stocks like PLTR, they face more scrutiny, don't they?
That's definitely a key point. Analysts are warning that, any negative news, any slight miss could cause PLTR's multiple to compress.
Compress, meaning the high valuation shrinks.
Yeah, exactly. The stock price could react strongly to even small bumps. But what's fascinating here, on the flip side, is just the sheer scale of the opportunity they're targeting. Government AI spending alone is projected to hit over $300 billion by 2030. Palantir is right in the thick of that.
Wow, $300 billion.
Yeah. And their CEO, Alex Karp, he describes the adoption of their AIP platform as a ravenous whirlwind. Strong words.
Ravenous whirlwind. Okay, but you won't believe it, there are potential headwinds on that government side, right? Like spending cuts.
That's the risk, yes. Things like the Department of Government Efficiency Initiative, potential federal budget cuts could definitely impact those government contracts.
Which are still over half their revenue. So that raises a big question.
How do they stand out in what's becoming a really crowded AI space?
Yeah.
Well, they position themselves uniquely as a foundational software provider. They're focused on what they call enterprise AI operationalization. Think of it as tackling the critical last mile of actually using AI in a business, not just providing the raw AI models. That's a key differentiator.
The last mile. Yeah. Okay, got it. All right, let's talk about the numbers that have everyone's head spinning. Prepare yourselves. These are kind of staggering.
They really are. Key insight here. Palantir stock surged an unbelievable, wait for it, 434% over the past year.
434%. That's insane.
To put that in perspective, the S&P 500, it returned about 13% in the same period, just leagues apart.
Unbelievable. And year-to-date 2025, it's already up 103%. Last 3 months, plus 14.6%. Even the last month, plus 10.4%. The current price is around $153.52. The 52-week range went from like $21 up to $155.
Yeah,
That's nuts.
it really is.
Its beta is 2.59, meaning it's way more volatile than the market. And it trades a ton. Average volume, 61.7 million shares a day.
And if we connect that volatility piece, Palantir's 12-month rolling volatility, it confirms these significant price swings. Right now, the implied volatility, or IV, from the options market is at 65.1. That's in the 57th percentile historically.
I mean, what does that tell us?
It means options traders are betting on even higher volatility, bigger price swings coming up than what we've seen recently. They expect the roller coaster to continue.
Okay. And for chart watchers?
PLTR is trading well above its 50-day, 100-day, and 200-day moving averages. That's typically a strong bullish signal, showing momentum is clearly upwards.
It's just one of the most spectacular runs in the S&P 500, climbing from that 52-week low. Just wow. Hey, if you're finding these insights as electrifying as we are, do us a favor, hit subscribe and leave us a comment. Let us know what you think. You're with ChannelVest. This is your analysis.
So performance has been phenomenal, absolutely, but it forces that really important question. Is this sustainable? Is the valuation justified? Palantir trades at a massive premium compared to other big software names. Its price-to-sales ratio, PS, is 122.66x.
122. Okay, put that in context for us. How did that compare?
Well, think about established giants. Adobe's PS is around 12.9x, Salesforce, 7.2x, SAP, 7.1x, Intuit, 12x.
Whoa. So Palantir's PS ratio is more than 10 times higher than most of those huge successful companies.
Exactly. That kind of valuation, frankly, only makes sense if you believe Palantir can sustain hyper-growth, like incredibly fast growth, for many, many years. It's pricing in near perfection.
So is there anything in their metric that supports that kind of optimism?
Well, yes and no. What's fascinating is their Rule of 40 score. It's an impressive 83%.
Rule of 40. That's growth rate plus profit margin, right? Should be over 40.
Correct. So 83% is excellent. It shows strong unit economics, a good balance of growth and profitability right now. They also boast a 44% adjusted operating margin and a 42% adjusted free cash flow margin, which shows really good cash conversion.
Operationally strong.
Okay, operationally strong, but the valuation. So what do the analysts, the pros, make of this whole picture? It's really mixed. Based on 16 analysts covering PLTR, the consensus rating is actually just a hold.
A hold, despite the run-up.
Yep. It reflects that cautious optimism tempered by these huge valuation concerns. The average price target is about $104.85. That's roughly 32% below where the stock is trading right now.
Below the current price. Wow. What about the range of targets?
It's incredibly wide. The high target is $160, so basically where it is now. But the low target, a shocking $40.
$40. That's like a 74% downside from here.
Huge divergence. You see wildly conflicting views out there. You've got Dan Ives at Wedbush, super bullish, saying Palantir's on a golden path to be the next Oracle. Could be worth $1 trillion in 3 to 5 years.
A trillion. Okay.
Then you have Mizuho Securities, more neutral. They acknowledge the stunning execution, but call trading at 97 times estimated 2025 earnings, very high. And then on the bear side, Jefferies warns about multiple compression risks, that valuation shrinking, especially in a normal interest rate environment.
Yeah.
Their target, $28.
$28. So bull case, $1 trillion, bear case, $28. That's quite a range.
Tells you how much uncertainty there is around that future growth and valuation.
All right, stick around because this next part, we uncover some seriously concerning data that could shake everything up. What about who actually owns the stock?
Good question. Ownership-wise, insiders hold about 3.64%. Institutional ownership, like big funds, is much higher at 55.86%. And that institutional number got a boost recently. Their inclusion in the NASDAQ 100 index back in December 2024 drove significant buying from index funds and active managers. Active ownership went up 5 percentage points.
Okay, so institutions are in. But here's a potential bombshell I mentioned. You won't believe this, but there's been significant insider selling, like notable amounts.
That has definitely emerged as a potential headwind, yes.
CEO Alex Karp himself, reports say he's sold over $2 billion worth of stock in the past 5 months.
That's a huge number.
And other executives. They've offloaded over $600 million through these things called 10b5-1 trading plans. What are those exactly, and why is this concerning?
Right, so 10b5-1 plans are pre-scheduled plans. Insiders set them up in advance to sell stock at specific times or prices. It's legal, designed to avoid accusations of trading on non-public info. But optics matter. Meaning, even if it's pre-planned, selling that much stock creates supply pressure, more shares hitting the market. And it can signal, rightly or wrongly, that executives think the current price is maybe a good time to cash out some chips.
Okay, so that selling pressure adds to the risks. What are the other big ones we need to connect this to?
Well, number one is still valuation compression. That 122x PS ratio is just highly vulnerable if rates stay higher or growth slows even slightly.
Right. And number two,
Government dependency. Still, 55% of revenue comes from government contracts. That makes them subject to budget politics, spending cuts, things outside their control.
got it, competition.
Competition intensification.
Mm.
Big time. Giants like Microsoft, Amazon, Google, they're all pushing hard into enterprise AI. That's a major threat.
They have deep pockets.
Exactly. And finally, growth deceleration. Sustaining the kind of growth they've had, like that 39% revenue growth, it just gets mathematically harder as the company gets bigger. The law of large numbers.
Okay, so multiple risks stacking up against that high valuation. Given all this, what do future scenarios look like? You mentioned some analysis.
Yeah, we looked at a few potential outcomes based on different growth rates and what valuation multiple the market might assign. A bull case, if they somehow sustain 50% plus growth and keep a really high PS multiple, say 80x, maybe the stock goes to $240 or more, possible, but requires continued perfection.
Okay, the dream scenario. What's more realistic? The base case.
Our base case assumes strong, but not hyper, growth maybe 25–35%, and the market assigns a lower but still high multiple like 40x PS. That suggests a price range of maybe $120 to $140.
Closer to the analyst average target then. And the bear case.
The bear case. If growth slows more significantly, say to 15–25%, and the market really loses patience with the valuation, giving it only a 20x PS, well, then the stock could drop to the $60–$80 range.
Which lines up with some of those lower analyst targets.
Mm.
So this raises an important question. How sensitive is Palantir to just shifts in expectations?
Extremely sensitive, because so much of its current price is based on future hopes. Small changes in growth forecasts or market sentiment can cause really outsized price moves. That high data of 2.59 confirms that expect way more volatility, bigger swings both up and down than the overall market. It's not a stock for the faint of heart.
Definitely sounds like it. Hey, don't miss out on future deep dives into markets moving this fast. Hit that subscribe button seriously and let us know what stock we should unpack next time.
So pulling this all together, what's the strategic approach here? If someone has, say, a medium-high risk tolerance, well, based on this analysis, a cautiously optimistic approach seems warranted. That means probably holding or maybe even reducing existing large positions. And for new money, we'd suggest waiting for a better entry point. It doesn't seem like the best risk-reward spot right now.
Why that caution? Why hold or wait, given the growth fundamentals you mentioned, like the rule of 40?
Because even with those strong fundamentals, the current valuation leaves almost zero margin of safety. That incredible 434% run-up, it's likely pulled forward years' worth of expected future returns into the current price.
So the easy money might already have been made, basically.
That's the concern, yes. The risk-reward balance looks less favorable up here.
Okay, so if people are waiting or managing positions, what are the key price zones you're watching?
We've mapped out a few zones. The buy zone, where valuation might start looking more attractive, could be around $80–$100. That would be a pretty significant pullback, like 35–40% from here. The hold zone is probably between $100 and $140. And the reduce zone, where risk seems highest relative to potential reward, is really anything above $150, which is where it sits now.
And a stop loss. Where do you protect downside?
A technical stop loss could be set below $70. A break below that level would likely indicate a more serious structural breakdown in the stock's trend.
Got it. So for listeners actually building their portfolios, listen up. What's the practical advice for fitting Palantir in?
A few key things. First, because of the volatility and valuation risk, limit your exposure. Maybe no more than 2–3% of your total portfolio. Don't bet the farm.
Okay. Keep position size small. What else?
Consider dollar cost averaging. Buy smaller chunks over time rather than all at once. That helps mitigate the risk of buying at a peak. Definitely set a strict stop loss, maybe 15–20% below your purchase price, to define your risk and limit potential losses.
And patience.
And patience, yes. Wait for those pullbacks, ideally below $120, to find better entry points where the odds might be more in your favor.
Makes sense. Beyond just the stock price, what key metrics should people be tracking to see if the Palantir story is staying on track or derailing?
Good question. What's fascinating here is looking under the hood. First, Track that Rule of 40 trajectory. Is it staying high, like that 83%, or starting to fade? That tells you about the balance of growth and profitability. Second, monitor the government versus commercial revenue mix. Ideally, you want to see that commercial side grow faster, reducing dependency on government below 50% by, say, 2027.
Okay, revenue mix. What about AIP?
Absolutely critical. Track AIP customer adoption metrics. How many are signing up? Are they staying? Monthly active users, retention rates. That's the growth engine. Also, keep an eye on free cash flow margins. Can they maintain over 40% even while investing heavily in growth? Shows efficiency.
And the insider selling.
And yes, monitor insider selling patterns. Does the pace slow down? That could be a positive sign. Continued heavy selling might remain a concern.
So putting it all together then,
Yeah.
what's the bottom line here?
Palantir really embodies both the incredible promise and maybe the peril of investing in the AI revolution right now.
Promise and peril, I like that.
The growth fundamentals are undeniably impressive, really strong execution. But that current valuation, it just leaves very little room for error, minimal margin of safety.
So what would the smart money likely do here, based on your analysis?
Well, smart money tends to be patient and risk-aware. Based purely on this analysis, they'd likely wait for much better entry points, or if they own it, maintain only small, manageable positions within a well-diversified portfolio.
Okay, so we've seen Palantir's incredible climb, the powerful tech underneath, but also the very real risks tied to that sky-high premium valuation. It's definitely a company right at the forefront of AI, but one that demands, a really deep understanding and a clear investment strategy.
Absolutely. And maybe this raises an important question for you, the listener, to think about. Given Palantir's unique spot in government and commercial AI, and how sensitive it is to growth expectations, how might just one single breakthrough AI application from a competitor, maybe a Microsoft or a Google, how could that fundamentally reshape Palantir's market position and its valuation, almost regardless of its own current performance?
Ooh, that's a good one. Food for thought. What if someone else leapfrogs them?
Something to definitely ponder as you watch this space evolve. It's moving fast.
Indeed it is. If you want more cutting-edge insights like this one, make sure you hit subscribe, ring that notification bell so you don't miss out, and hey, leave us a review. Let us know how we're doing. You're with ChannelVest. This is your analysis. We'll see you in the next deep dive.